Hello, this is Whitney Emmanuel. Welcome back to the last video in our series on recession-resistant investing. Today, or in this session, we're going to be talking about insurance. So this, again, is a solution that we provide to our clients who fear recession and want to safeguard a portion of their portfolio. The most common insurance solution that we use is an annuity. The reason this is a recession and resistant is because they can provide downside protection that traditional stock and bond investing doesn't provide. In contrast to bank insured notes, which I discussed in the last video, check it out if you haven't already, annuities are backed by the claims paying ability of the issuing insurance company. For this reason, it is important to look at the health of the company that is issuing these solutions, just like you would look at a bank and how healthy they are. For this reason, it is important to look at the health of the company, as I mentioned, and how you do that. You can actually look at Standard & Poor's is a good rating agency that looks at how well are they rated. AAA is the highest, and it goes all the way down to BBB. Most often, we use annuities in our practice for guaranteed income replacement. They are very similar to bank insured notes in that there is a term and guarantee if held to term. Two key differences. Annuities have longer terms. There are surrender charges. So it's not just a potential loss of value. There are also surrender charges with annuities. And they are backed by an insurance company, which I mentioned before. And there's tax deferral. So if you let's take aside IRAs, but if you just had some cash and you wanted to invest it into an annuity, you're not paying taxes on any of the gains or income or dividends on those funds, because it's deferred by the tax sheltered annuity. There are a few types of recession-resistant annuities. One, indexed annuity. An indexed annuity, we'll talk about what each of these really means. There's a fixed annuity, and then there's a variable annuity with downside protection rider. Of these annuities, there are a lot of different flavors. Indexed annuities perform according to an underlying index, similar to a bank-insured note. The reason that investors choose this as an option is for less volatility than a variable annuity. Fixed annuities are not linked to the market. Their performance is based on the declared interest rate at the beginning of a contract. Think of a CD. It's very similar to that model. A variable annuity with downside protection is invested in mutual funds offered in the contract. If you add a rider for downside protection, you can gain upside without the downside. With every annuity we mentioned, you have expenses associated with the contract, and the payments and guarantees are backed by the claims paying ability of the insurance company. Mentioned that a couple times, but just so you are clear on that. Another recession-resistant investment is a whole life insurance. Because cash value life insurance is primarily used for insurance, you have other considerations such as the cost of insurance and the death benefit. However, the living benefit of a whole life insurance policy, which is the cash value you have access to in your lifetime, is guaranteed and grown by the claims paying ability of the issuing insurance company. That cash value is not subject to market fluctuations, and the insurance company pays dividends to increase the cash value over the life of the contract. Incorporating whole life into your portfolio can provide you tax-free assets, a tax-free death benefit for your beneficiaries, and reduce volatility in your portfolio. Keep in mind, none of these solutions are foolproof. The insurance and bank products are only as good as the claims paying ability of the company. Essentially, that's their financial health, which is why, in my opinion, cash is the safest option. However, it typically provides the lowest rate of return. On the opposite side of the spectrum, if you're willing to take on more risk, an annuity could be a good option, as it provides you the highest return potential of all these options. We would love to explore this and build a customized portfolio for you and your family that can weather the storms of a recession. We look forward to discussing this with you soon. Blessings.